Hi guys, and welcome to Trading and Investing with Carl. In today's video, I'm going to give you my market update and outlook as the new week has started. First of all, we are going to start with something Michael Harnett from Bank of America said. Markets stop panicking when policymakers panic. Just let that sink for a few seconds. Now we saw Australia's central bank took action. They doubled the size of the bond buying today and may continue to be more active in the future. And the effects of the buying program produced the second biggest drop in the Aussie 10-year in the last 19 years, down 27 bips, and that's a lot for the bond market. The biggest was when the world was in full pandemic mode last March. But what kind of panic do we have now? Here you also can see of the 10-year Aussie bond the severe drop we've had. Next on, we're going to talk about what Andrew Haldini from the Bank of England said. He said, inflation is the tiger whose tail central banks control. There is a tangible risk inflation proves more difficult to tame, requiring monetary policymakers to act more assertively than is currently priced into financial market. He basically just wants to say that the problem with the inflation is going to get bigger and bigger, and he thinks it's not that easy to get under control as the central banks say it publicly at the moment. And that is also a thing the financial market didn't price in yet. We also have Isabel Schnabel from the ECB, who said the ECB may need to add support if the yields have to grow. She is a little bit more conservative in the things she's saying, but with that quote she was saying she also recognizes the problem that is coming from the bond market. Then we also have the Greek ECB member Stounaros, who sees it a little bit more drastically than Ms. Schnabel. He basically wants that the ECB is starting as fast as possible with more QE. So when is the Fed going to recognize the problem that is coming from the bond market? Sooner or later, in my opinion, they will have to react to that problem, or at least admit that there is a problem, because the market tends to trigger problems till there is a solution for that problem. But in the short term, we could see a tactical pause here and some kind of consolidation in the bond market. But in the long term, as Goldman or Nordea says, the global route in bonds has room to run. So I think in the long term, the problem with the rates are going to get even bigger. But now I'm going to show you how also the technical picture in the chart fits to the statement that we could see some kind of consolidation. Here you can see the 10-year treasury yield. You can see we've bounced back at a major resistance zone and we went really hard. You can see it here in the RSI. A few hours ago we were at extreme overbought. So we could see here some kind of bouncing around and consolidation before we start to make the next move to the upside. Here you can see the MOVE index. The MOVE index is basically the same as the VIX, so the volatility index. It is just for the bond market instead for the stock market. So it shows the volatility in the bond market. You can see the volatility got extremely high in the last few weeks. Here you can see the comparison between the MOVE index and the volatility index. You can see there is some kind of correlation between those two, and you can see every time the bond market or the stock market picked up in volatility, also the bond market or the stock market picked up in volatility, but it's not a one-to-one correlation. Next on, you can see in the chart that is above, you can see the market price probability of Fed raising rates by December 21 has been rising. You can see we were at 0% a few months ago, and now we are at 7%. So that was rising quite quickly. In the chart down below, you can see the orange line, that's the copper gold ratio, and in the blue line, you can see the 10-year treasury yield. And you can see there is some kind of correlation between those two. You can also see now the copper gold ratio rose faster than the 10-year treasury yield. And the thing with the copper gold ratio is it is, in my opinion, a very good indicator for inflation, because if copper gets more expensive compared to gold, that means there is high demand for copper, and copper is an industrial metal. that is needed for a lot of goods, and the high demand in goods could lead to higher inflation. And in my opinion, it is just a matter of time till the blue line matches the orange line again, and in my opinion, it's going to be the rates that are going to rise and going to pick up to the real inflation of the market. Next on, you can see the Bloomberg World Stock Market Index. You can see in the blue square that is the month February, and you can see the first 11 days of the Februaries we had only positive green numbers, so we were continuously rising. And then at one moment we saw the rates rising, and you saw the market was getting afraid of those rising rates and was getting afraid that the central banks lost the control. And that was the moment we had 9, or if you don't want to count the 0.1, we had 8 days of negative red numbers. Next on, we have another chart from Bloomberg, and that's the global stock market capitalization. You can see here in the last drop we've had last week, the markets lost 3.5 trillion US dollars. That is almost equal to the GDP of Germany. And that was because the tech sector came under pressure because of the rising bond yields. Next on, we are going to look at more technicals on the chart. First of all, we are going to start with Bitcoin. We had 2 bearish breakouts, both out of those triangles. But now we've built this massive falling wedge we broke out of. We got the confirmation. The only question is, how far can we go up? So in my opinion, this is no financial advice, we could go to this level here, because this was a previous resistance level which is still existing. But if we break through it with a lot of volume, we could see another move to the old all-time high. Just be aware of, if we bounce back from the old all-time high, we could build a double top. Next on, we are looking at the Nasdaq. We are still out of the bullish trend, but we've bounced back at this massive support around here at that purple line. We can see as the yields are falling in the bonds again, the stock market starts to pick up again. If you want to be speculative, you could place a long order here and take profit at the downside of the channel. And if we break through this resistance and get back into the bullish channel, this could mean we could see more on the upside. Next on, you can see here the S&P 500. You can see we've bounced back into the bullish channel and are still in the bull trend. But you also can see here in this area there is some kind of resistance. So if we break through this resistance, the next target would be around 4,000. Next on, we are looking at the Dow Jones. You can see here, after we broke through this support area, we bounced back, same as the S&P 500, back into the channel. Now it's going to be interesting if it can break through this old resistance and now again new resistance and continue the uptrend and bouncing back and forth on this support line, or at the moment still a resistance line. But for now on, we opened with a gap and the picture looks very bullish for the Dow Jones. You can see the US dollar index. You see we've broke out of this falling wedge, had a retest, had another retest, and now it works as a support. This also happened because of when the rates in the bond markets are rising, the US dollar tends to get stronger. But it weren't the case in the beginning, but now the US dollar gets stronger. But this also means it could possibly affect the stock market, because a strong dollar isn't good for the stock market. And with that all said, thanks for watching. Please smash up the like button, maybe subscribe to the channel, I would love it. And good luck with your trading, good luck with your investing, and please don't get wrecked, people.